Hello and welcome to the Truth About Real Estate Investing show. This is the show for Canadians. I am Canadian born and raised. My name is Armin Cito, and I've been a real estate investor since 2005, full-time in real estate since 2010. And since then, we've helped investors transact on over $420 million worth of income properties, including about 100 small multifamilies and another 100 or so student rentals. For those new to the podcast, this podcast is a truth-seeking journey with over 300 episodes, each an hour long, generally of successful investors on different investment models, what it took for them to become a successful investor, also how they fail. So I personally never believe anyone who says they've never failed at anything. So that's the truth about real estate investing. Anyone who says they've never failed before, there's a good chance they're lying. And there's a good chance they could be lying about their successes as well. The lessons learned, so we learn all these lessons together, so we may together continuously improve on our investment businesses and in our lives. On this show, we explored what makes people tick, how much time it takes for them to do what they do, the amount of effort, the resources they have to invest in order to obtain the results that they do. My intention for you, the listener, is to learn and find an investment model that suits your own values, style, resources, so you may model the success and avoid the landmines like the pros do. One thing I've noticed many beginners and some pros miss is the understanding of why we must invest in hard assets, especially during inflationary times, which is... in case anyone thinks this is the only inflationary time, understand, real estate prices have been going up about 7% in Ontario for quite some time. Many focus on things like supply or lack of supply of housing and the impossible demands caused by on our housing supply, the impossible demands caused by our immigration. Then they can't explain why houses prices have gone up so much. Because there's actually some examples around Canada, including in Vancouver, where they've created a sufficient supply, but yet house prices still have gone up. One thing causing inflation is the growing supply of money. And we can thank our government for that. The amount of borrowing that they do, the printing of money, plus low interest rates cause our banks to lend like crazy, which again creates more money. In the last 10 years, so I actually I've supplied a chart in the show notes on the website, truthaboutrealestateinvesting.ca. And if you're on our email newsletter, you'll see it in the email as well, the chart that I post. In the last 10 years, Canada's money supply, so the amount of money, amount of Canadian dollars in the entire system, so that includes in your savings account, in all the businesses' savings and checking accounts, the dollar bills that you have stuffed in your mattress. If you add up all that money, in the last 10 years, it's actually gone from $1.2 trillion to $2.4 trillion. So it's doubled. The amount of money in Canada has doubled, including a significant ramp up since the pandemic, and it has not slowed down. The pandemic money supply, growth of money supply has not slowed down, which goes against what the Bank of Canada is trying to do. At the same, while the federal government's stimulating the economy and causing inflation, the Bank of Canada is trying to do the exact opposite by raising interest rates. The Bank of Canada, so that's kind of interesting how our government chooses to operate. Anyways, and then do you ever see this not happening anymore, where the federal government, actually reduces supply of money? Like the Americans actually did. For a few months, they actually did. Now with their debt heading towards their debt ceiling, they're going to start creating more money as well. Anyways, so again, there's a chart in the show notes. And I was explaining this to a room full of Toronto real estate investors just last week, and also some novice real estate investors as well. Because again, it's not something that's commonly known. Why real estate or hard assets, why they go up in value. And based on the increase in money supply, hard assets such as land, which is, there's land under all my income properties, it should in theory have doubled in price. Looking back 10 years ago, we were buying detached homes in Hamilton for $290,000. And since then they've tripled in price. So they've more than doubled, and they've increased. Yeah, exactly. Again, they tripled. Same for St. Catharines. We were buying detached homes in St. Catharines. We were buying for just over $250,000. We were paying about an average of $255,000 10 years ago. They've also nearly tripled in value. This is important information when forecasting what will happen to real estate prices in the future. knowing how central banks, including the Bank of Canada, they will always continue to print money. How the housing crisis will only get worse as the builders in the last 12 months they've been off. Not all of them, but many of them are not building because they're not selling. There's not much appetite for pre-construction houses and condos. Houses more so in like really small markets. But anyways, the supply of pre-construction condos and houses has to be absorbed first before it makes sense generally for builders to continue building. Anyways, and the trend also is for more immigrants each year. Add in how interest rates, they've likely peaked. We may see another quarter point interest increase, which I actually think is good news. Right or wrong, I still think, again, a quarter point increase would be nice because it gives my buyers, my clients, more time to be able to buy properties and take advantage of the last downturn. So, and then based on economic fundamentals, it still makes a lot of sense to buy and hold quality investment properties. Note mine and my clients' experience of generating wealth in real estate is not the same for others. Not all real estate goes up. For example, I had some friends visit to record a podcast just 2 weeks ago. They're Calgarians, and I'll take their word for it. They live in Calgary. They're real estate investors. They shared how their market has only gone up 20% in the last 17 years. 20% in 17 years. So some might think that's good. I believe they have not kept up with inflation. So that's actually a poor investment. Therefore, it could be worse though. If you invested, sadly, in Calgary commercial office, that's down even more. And I don't have the Edmonton stats offhand. But anyways, again, what does the future hold? Nobody knows. But for my clients and I, we will continue to ride this trend of a market appreciation through owning quality investment properties until it ends. Investor market update wise, we are picking up some great deals thanks to the recent downturn, and as mentioned several times already, we are well past the bottom based on what we're seeing. The bottom, I believe, was August last year. Last week we had a client pick up a newly renovated duplex in Kingston, Ontario for less than the seller paid. Unfortunately, the flipper, the seller, they bought near the peak. They paid, and then they bought a house, and then they had to renovate it. They turned the single family home into a duplex, and now they sold it to our client somewhere less than $150,000 than what they invested. So they're probably going to take close to a $200,000 bath on this, while our client was, of course, ecstatic as she picked up a great deal that will cash flow. And again, it's a newly renovated duplex. So unfortunately, that's how the cycles work. If you invest poorly, you'll be shaken out of the market. Hopefully, this flipper was a regular flipper, so hopefully they made lots of money on the uptrend, and they're just taking a decent sized haircut on this one. Also, so thanks to the downturn, we're picking up bigger and better properties with development options. Thanks to Bill 23, both in the East End and the West End. We're picking up a lot of houses with detached garages, so we can convert those garages into apartments to increase cash flow and, of course, our property values. It is actually a good time to be a buyer. It's actually possibly one of the best times to be a buyer in quite some time. So if you're interested in working with a team of professionals, if you enjoy using professional services, ours is particularly award-winning. For those who don't know, we are the 4-time Realtors of the Year to investors. We are investor-focused realtors. I personally am I've been an investor-focused agent since 2010. So if you're interested in working with one of us, contact us at iwin@infinitywealth.ca. Again, it's iwin@infinitywealth.ca. If you're more interested in improving your education at this time, you're not ready to jump in, we are hosting an iWin Mastermind Tour east of the GTA on Saturday, June 3rd. Starting at 10 a.m., we meet for coffee and then we do some networking. Then we tour some houses, usually two, usually a duplex conversion or a garden suite / garage suite conversion. And of course, we always provide handouts with cash flow analysis and some design drawings if applicable. Then we're off to lunch. So Coach Stephen Phillips, who is hosting our tour, he actually has a commercial property where he's renting out his parking lot to 2 food trucks. So it'll be both learning It'll be both educational and a bit of commercial real estate investing, as well as enjoying local food trucks and supporting local. These events are fun-filled with networking, high-quality tactical education that I wish existed when I first started. But like I've been saying, it's never been a better time to learn how to invest in real estate. Quality education has never been so accessible, but also on the other hand, extremely poor, overly expensive education is also available. So if you're interested, do not delay. We do have a hard cap of 30 attendees. Half the spots are already sold. The cost is a whopping $20 plus taxes and fees. Clients, you are our guests, so you do not pay. And also, all proceeds go to our registered charity, the Hamilton Basket Brigade. And again, I've shared the link in the show notes. Again, link in the show notes in www.truthaboutrealestateinvesting.ca. And to stay connected about our events, I can't recommend enough that you subscribe to our free email newsletter. We're about to announce our next tour in the West End, which will likely be Hamilton, possibly Niagara region. So we'll announce that also in an email newsletter as well. So you do not want to miss that. So make sure you sign up for our newsletter on our website, truthaboutrealestateinvesting.ca, name and email on the right side, and you're good to go. On to this week's show. We have some great guests who have just launched their new apartment building REIT, a real estate investment trust. If you don't know what that is, it's a fund where the underlying investment is a bunch of apartment buildings, and regular investors like you and I can invest to own shares in the fund and participate in the investment. Mike Rockall and Mark Baltazar are our guests today. They are the founders, owners of Peak Multifamily Investments, and I've known Mike a long time. We met somewhere around 2010 as we were both members of the same real estate investing network. I know I talk like an old person because I am, but I knew Mike when he was still in school. But thanks to a lot of hard work, surrounding himself with go-getters, some great mentorship, he's been full-time in apartment buildings for several years now. And again, he's now a co-founder of a REIT. He's come a really long way, and he's quite a successful individual. On the show, we discuss the journey, and we get a bit detailed on things like when to set up a REIT, the cost to start up a REIT, who they need to hire, partner with to raise capital. We touch on securities regulations, which anyone listening who raises capital should pay special attention to if you want to stay out of trouble with the Securities Commission. You please do stay out of trouble with the Securities Commission. We already have folks in our community who've been shut down by their local Securities Commission. Anyways, if you're ever looking to partner, as Mike and Mark have, they share how their partnership works, their roles and responsibilities, how they organize their business, organization hierarchy, and they describe who owns what. And of course, we break down some recent deals. We discuss the makeup of their portfolio, cap rates, how they increase values. Something I want folks to pay attention to is cash flow. And I want to thank Mike and Mark for being so transparent on where the cash flow actually comes from. And it's not where most people think. To learn more about their business, Peak Multifamily Investments, you can go to peakmultifamily.ca. As we are discussing a securitized investment, here comes the legal disclaimer. The information and opinions expressed in this podcast are solely for educational and informational purposes and should not be considered as investment advice. The hosts and the guests of this podcast are not licensed financial advisors, brokers, or registered investment advisors, and their comments should be not be construed as recommendations or endorsements of any specific investment, security, or strategy. Investing involves risks, including possible loss of principal. Before making any investment decision, you should conduct your own research and consult a licensed financial advisor to determine the suitability of any investment for your specific financial situation and investment goals. The hosts and guests of this podcast make no representation or warranties as to the accuracy, completeness, or timeliness of any information discussed on this podcast. The podcast is not responsible for any errors or omissions or the results obtained from the use of this information. Listeners are advised to use their own judgment and seek the advice of professionals before acting on any information provided in this podcast. The podcast shall not be liable. The podcast shall not be liable for any damages, including but not limited to direct, indirect, special, or consequential damages arising out of or related to the use, inability of use, or reliance on the information provided in this podcast. This is a really great episode, so for anyone interested in learning about large-scale investing, please enjoy the show. Mark, Mike, thanks for coming in. What's keeping you busy these days?
Thanks for having us. Well, we launched a REIT that we were just talking about, so that's keeping us really busy.
For the beginner, what is a REIT? What's this?
So it stands for Real Estate Investment Trust. It's really just an investment vehicle. To kind of simplify it, it's a way. So a REIT essentially is a company that buys, operates, owns real estate. It's kind of specific to real estate. So that for the purpose of it appreciating and cash flowing. Mm-hmm. That's kind of what a REIT is. Right. The legal structure allows people to invest, with a company, with a REIT in a passive way. And it could be registered funds, non-registered funds. So the REIT structure typically allows, again, not a complete expert, but we're going through this. Well, we've gone through it right now. So fairly fresh. It allows people to use registered funds. That's one of the big benefits, I think, that why we went down that path is it opens it up to registered funds, which is fairly significant in Canada and the US for 401k, although we're not in the US, but registered funds is really underutilized here as a pool of capital in Canada. So
just for some clarity, there is one step further. Like we opened a mutual fund trust. You can do a REIT that doesn't allow in registered funds. So there's another step to become registered to take in that RSP and that TFSA capital.
So it took you 2 steps before you get accept registered money.
Yeah, it's a whole separate document.
And this is done over a weekend with a lawyer. Just lock yourself in a room and hammer out some paperwork. And
if you have ChatGPT, you can probably do in a weekend. No, this was months. Months, almost a year, probably almost a year.
Months to a year.
Yeah,
probably about 8 months from when we said, okay, let's go. Couple of months prior with some consultants and kind of figuring out, are we going to do this? Are we not going to do this? But it's a lengthy process.
Mm-hmm. And you mentioned lawyers; they're not cheap.
No.
You mentioned consultants; they're not cheap.
Not cheap at all.
No.
What's the ballpark for?
So I think set up without any marketing, we're probably about 150 to 175 to kind of get it all set up.
Very serious decision to make.
Yeah. Like you might hear people say, well, yeah, I can set up a fund for $30K. I've heard that a lot. You can set up a GPLP for $30K, or maybe like a general partnership, limited partnership. Yeah. That could be a fund. That's probably one way to structure a fund. The path that we took is a little bit more complex, but the complexity allows us to expand our reach, essentially. Mm-hmm. And that was really the purpose of the whole exercise.
I think too, because we've heard this lots, is building an OM, an offering memorandum, is about $30,000. And for someone to draft it, you probably can draft it for that $30,000. It's everything else that comes along with it, and DD checks, mm-hmm. and lawyers reviewing it, mm-hmm. and getting on the shelf of an exempt market dealer. Dealing with Olympia Trust and their review. Total cost puts you well above $100,000, right? But you hear people, and me and Mark now look and say, "Oh, they're in the early stages." Someone's saying, "Oh, that's expensive." I was told I can draft it for $30,000.
Right. That's just one part.
So were we.
It's one step. Yeah.
And you can now we're able to gauge, they're just kind of exploring the option.
Interesting. Right. So to the ignorant person, like offering a memorandum, you can't just get like a template?
Yeah, you can. So I think so.
Because your business is similar to other real estate
100%.
investment trusts.
Yep.
Right? But you can't, I'm always looking for
ways to save money. Sure. So let's say, offering memorandum, let's just by way of example, it's a document essentially that outlines the nature of the business, the risks. There's a whole bunch of stuff that goes in there, right? The legalities, how investors can come in, how they can get out, the redemption policy, a whole bunch of stuff that's important to people, right? So let's say it's 100 pages. 80% of it's probably templated, right? Maybe more actually, because you're right. Because it's obviously we're not the first. This is it's a model that's worked. Where I think the time, at least for us anyways, was deciding what does the investment product look like? Like what's the returns? What's our performance fee? How much are we sharing with investors in terms of equity? What's the do we have hurdle rates? So like basically And one of the consultants we worked with and still work with and helped us develop this, he called it kind of investment product manufacturing, right? So you're creating an investment, but there's so many variables to it. There's the rate of return, there's the how long you get paid back. So there's all these things, kind of features. That's I think what took a bunch of time for us, is figuring out what does the market want, right? What does the market want? Let's craft something.
Okay.
Can we develop does our business model suit that? That's a big time consuming component as well, is like, can our business model deliver what the market wants? There's a lot of due diligence that gets into that, and there's we had a bunch of people help us along the way. So
this is I'm really geeky. I'm a bit of a real estate geek. I don't know if people know that. What does the market want in terms of return, risk profiles, all those sorts of things? Because like we were talking before recording, like there's all these courses being taught out there.
Yeah.
One of the biggest misses I see with novice investors and people who are being coached is they don't know what a deal looks like. As in, like, they don't have enough information to decide if that is actually the right deal for them.
Yeah.
So I think by asking you like what your return profile has to be, I think that's probably a good baseline for most.
Yeah. So you get into, I think, market segments, right? So I think there's the retail market, right? So the people that may be investing in mutual funds, perhaps stocks.
Even like people investing their self-directed RSPs. What are they looking for? What type of risk are they bringing in?
Yeah. Call it every day. Yeah. At least this is how we look at it in a really broad spectrum. So there's a retail, and then there's I think there's the more sophisticated, right? And the more sophisticated.
Our listener, yeah.
Yeah. No, but I think it would be your listener, because they understand real estate and how it works probably a little bit more. They definitely do, more than the average person, right? Because I think the average person, when you think about real estate, at least my hypothesis, they think about the housing market, right? And that is real estate, but it's only one sector in real estate. There's so many other different categories: multifamily, self-storage, industrial, and such. So typically when we started Peak Multifamily a number of years ago, we were working with more sophisticated investors to come into our deals. More sophisticated investors typically want a higher risk return profile, right? 15% plus. What we've started.
50% over what term?
Over per year. Over our projects were typically 5 to 7 years, right? Turning over a building and such. Okay. As we start to learn more about kind of the retail market, when you're quoting rates of return anywhere north of 15%, that also raises flags in terms of risk, right? It's a very high number, right? Like, you think of a stock that might do 15 to 20%, there's probably a lot of volatility there, right? And so,
don't we all know?
Yeah, right. So a big learning for us was that learning the appetite of the market doesn't necessarily, it's not always about the high number, right? And the asset class that we're in is multifamily. It's typically a little bit more stable, right? It's a little bit kind of maybe more boring than other asset classes. And so people kind of coming into that sector, investing in that sector, don't want kind of these crazy returns, because crazy returns also mean that there's risk, right? So I think you kind of have to put two and two together. So what we're learning is that people are in this asset class for stability, right? When the stock market is doing what it's doing right now, a little bit of volatility, they know that their capital in an asset class like apartment buildings isn't doing that, right? It's also not mirroring the single family market, which is also maybe going downwards a little bit more than most. So we're understanding kind of the risk appetite and the risk return appetite right now. So long-winded answer.
Right. So, but the soundbite, the soundbite for Adam. The soundbite would be like, people are like 50% return over 5-7 years is kind of like a place to be. And
I would say in that sector, in that market of retail capital, it's high. Dealer reps will kind of perceive that as a riskier product, right? And the question that came up to us is, like, when you're looking at other products, you're looking at some of the bigger REITs in the space. It's like, well, how are you guys doing better than they are? What are you guys doing? Right?
Yeah. And isn't the paper today I won't name names, but very large REITs just cut their cash distribution by 70% because they have a lot of office commercial.
Yep.
I think we all know return to office is
It's taking a hit.
big hit, right? So
yeah.
Sorry.
And just going back to like manufacturing that financial product, it's like all the fees that come along with it, right? Like financial audits.
Thank you very much.
No, but just everything else, like annual offering memorandum updates and stuff like that, figuring out all those fees associated with it, and then kind of analyzing the properties that we're buying and kind of fitting them into this financial model to create a return that suits that retail capital. Right, and that's where the lengthy, kind of process comes. Is how does the market perceive this? If we're coming out saying 15 to 17% return, how is that perceived in the market? Right?
That'd be crazy.
Well, we probably wouldn't have exempt market dealers raising capital for us. Right, like they would raise more if we were to say 10 to 12. Because now
no one believes you.
No one believes you.
Which is hilarious, because if you say that in you're offering a course, people sign up.
Well, I think that's my point. Is like there's the segments, right? There's the retail, and then the more sophisticated. Like the more sophisticated can probably do it on their own, or might have the network to kind of get it to like more private investments or joint ventures that will probably do more, right? But there's also more risk associated with it, right? Like there's got to be a trade-off,
right.
And so, yeah.
Which again, what's kind of the point of the show? Because you guys have successfully done so. You're sophisticated investors yourselves. You didn't start right away. You weren't born into this business, right? You weren't born owning apartment buildings, right?
Yeah.
You had to do it yourself.
Yeah.
So it is possible, but it's not that common, right? Because like you guys have been in the community forever. How many people said they were going to open a REIT? How many people actually did?
Yeah.
Not common, and some have gone under. Like we have mutual friends whose REITs they've sold them because they failed.
Yeah.
Right. So it's not all sunshine and roses.
Yeah. No, it's work. That's a process. It's work. It's effort.
So this is actually a very complicated topic. So I don't know where my listener wants to go next, but. We will get to your background. I just don't want to leave this just yet. You mentioned exempt market dealer. For the beginner, what is that? Like you're not out there knocking on doors selling shares yourself of your REIT?
No, so it's funny. We just published an article on our website. What is an exempt market dealer? Because we're getting that question a lot. Because the whole and I won't do it justice, but I'll kind of do my best, right? So the exempt market, kind of by definition, is also called the alternative investment space, right? So these are investment opportunities or products or things that people can invest in outside of the public markets. Public markets being things on the stock market, for example, right? And so typically these private investments were only available to the ultra wealthy, right? Through connections or whatever it may be. Accredited investors. A number of years ago, and I don't know exactly when, let's say 12 to 15 or so years ago, the exempt market space started to kind of be created, if that's the proper word.
It got bigger. Canadians were getting richer.
Get bigger. And so there was a need for, issuers, like companies like us, to raise capital, but also there was an appetite to invest in private markets. And so the exempt market dealer, the role of the exempt market dealer is to kind of connect, companies like us with retail investors. But the important part of that is that they're registered and they're certified and they're educated enough to determine whether an investment is suitable for an investor, right? So they're kind of the intermediary that connects companies like ours, REITs, private investments with investors. And so that's their role, right?
They're licensed to sell securities.
Exactly.
Their job is to screen people to make sure
it's right for them.
So even when we are raising capital ourselves, it still goes through them, and they're the back office doing everything. So it's not just us. Okay, we've raised capital. They raised capital. It's us, getting the interest of people and then pushing them to the exempt market dealer to make their final decision with them.
Right. So this is actually a really good discussion, because before we're recording, we're discussing how many people are doing this wrong. And they're doing it on social media, publicly, available for everyone to see.
Yes.
Like, for example, I discussed a company that went under. Because they had the trigger. They were going to go under no matter what. But the triggering event was their competitor. The rumor is their competitor filed a complaint with the Provincial Securities Commission, and then the company that eventually went under had a cease and desist order. Right. Like it's like, that's why you don't air your dirty laundry in the public, right? And by me saying dirty laundry, like I see people raising capital on social media all the time even taking sponsored ads to do it, and they're not licensed.
It's, I don't know. We talk about it often because we see it. We're on social media, right? Like, I mean, we're there promoting ourselves, but also seeing what's out there. I don't know if I'm surprised that many people are doing it, but it's surprising. And these are not stupid people. No. They're smart people. So it's either they really just don't know that they're in the wrong, or they know they're in the wrong but are trying to still do it. I don't know. It's a really interesting thing. I don't know. I mean, for us, that's very risky. Not just for us, but also for investors. Like, it's very risky for the investor. And I think one of the things that investors really need to think about when they're partnering with someone or investing with someone is, are they doing it legitimately, right? The deal could be, so there's two things. Like, they could be operating a great business, right? And raising capital incorrectly. There's a lot of risk there, right? The business model may work, but if, this situation that you just mentioned, if they're offside on the capital raising side, that shuts down capital to your business, which needs capital to run, and your business model kind of falls apart.
Yeah, because real estate, I understand, is pretty capital intensive.
Yeah, and especially as you get to larger stuff, right? So, I think people have to really think about how risky it is for them and their investment if the company, the issuer, whoever the person that's operating it is not doing it properly. So they, there's probably some more due diligence that they should be kind of undergoing to make sure. Yeah.
And I've asked my lawyer.
Yeah.
I'm shocked how many people either haven't asked their lawyer, or they're going against their lawyer's advice, or they're just willing to operate in the gray.
Or they're asking the wrong lawyer.
Yes.
Good Lord.
I was just going to say that. Make sure it's a securities lawyer.
Yeah,
right? Like, when we're talking about investments and agents and all that stuff, you're not going to use your residential agent if you're looking for an industrial property. Well, same thing when it comes to this. You're not going to use a real estate transactional lawyer if you're talking about securities now. And you see that a lot happen in the space. And we've asked for years, and we've always got answers that weren't clear. Can we do it? Well, I don't think you can, or maybe you can. Like, how many years have you spoken to lawyers and no one gives you a straight answer?
Even when you call CRA, it's hard to get a straight answer. You call back, it's a different answer.
And I think, this came up the other day because we were with our exempt market dealer. We're having lunch and just kind of talking about kind of the future and growth. Some lawyers will also say, I can advise on this, but they may not be experts in that area, right? So buyer beware, I guess, right? Like, you could ask your lawyer and they might provide advice. It's still up to you whether or not that advice is correct or not, even though if it's coming from a lawyer. Like, I know when we ask our lawyer stuff about real estate, I don't know. It's just like, go ask the real estate lawyer. Or if we ask our real estate lawyer, hey, what do you think about it? Go ask your securities lawyer. So that's what a good lawyer should do, is like defer to the expert and not just kind of take that. So I think that's, gotta really watch out for that kind of stuff.
And just because we're a REIT, we can't put out any marketing that we want. Like, our exempt market dealership has a compliance officer, and every bit of marketing we put out, we have to send to them, get it approved, then put it out. And a lot of times it's like, oh, you guys need to put a disclaimer here, or can you switch this around and add this there, right? That's typically what happens, even though we are a REIT, right? We can't just pump out marketing, but you see it a lot over social media, guys just pushing all this stuff out. Right, so even being registered, we're still very wary of what we can do and what we can't do, because it's not just a free for all. We're a REIT now. Pump out the marketing. It doesn't work that way.
I actually had a discussion. I had a DM discussion over Instagram with a mutual friend of ours. I told him he posted something. He was raising capital, talking to his phone on Instagram story, video, whatever. Yeah. I said, "Can you just do me a favor and please run that by your lawyer? Can you just take it down while you do that, right?" And then he took it down, and he asked me, but he says everybody else is doing it. I'm like, it doesn't mean that's right.
Yeah.
And so he asked me, how do you do it? I said, why do you think all these people are selling coaching? Right? Because you're selling coaching, you're not selling securities. Yeah. You sell coaching.
Right.
You teach them how to do the investment.
Right.
And then a lot of them raise capital from there.
Yep.
I'm not saying that's wrong, because I think it can be done properly.
Yeah.
Right. It's just like multiple representation in real estate.
Yeah.
One can represent both the seller and buyer properly. It's just not common.
Right.
There's this conflict of interest.
Yeah.
So again, it can be done well. It can be abused, and it probably is abused a lot.
I think so.
Yeah.
I don't know. It's hard. Yeah, it's hard to say. I don't know what advice people are getting. It's interesting to see like that kind of stuff. Like, you know, we see it all the time, and you wonder. It's like, I don't know what kind of advice they're getting. Maybe they're getting proper advice. It's hard to say. I don't think so.
The question is how are you providing the best interest of the investor when it's your investment product, right? You're looking at it from your best interest and saying, no, you should invest in this project. You don't know what's right for them. Yeah. Right. So you're essentially convincing them to invest with you regardless of their situation because you have that vested interest in the project. And that's where kind of it gets really tricky because it's if tricky. You're not at best interest for them, well, you're technically in the wrong.
Like buyer beware. I literally had a school teacher reach out. She some financial difficulty. A mortgage representative recommended that she put money into a syndicated mortgage on a development. And where did she find the money? He got her a home equity line of credit.
Oh wow! Yeah.
So he got paid on that. He probably got a referral fee on referring her to the syndicated mortgage.
Yeah, for sure.
That developer went under. Very public.
Oh shoot! Yeah.
Very public bankruptcy.
Yeah.
Right. You guys probably looked at the properties that they were fire sailing.
Yeah.
I did. I'm sure you guys did.
Yeah.
But yeah, like buyer beware. Like there are sharks out there.
Yeah.
And some people like, and I'm not saying the mortgage person was evil. He might have thought it was actually a good deal.
Right.
But again, like it's just conflict of interest, and you're exposing everyone to more. Well, I would never do a syndicated mortgage on a development property.
Yeah.
Right.
Interesting. There's so many stories like that.
Like so sad. Someone who's mortgage free now is a big mortgage now.
Yeah.
Right. And no return coming forward.
No return.
Yeah. Very sad. But yeah, buyer beware. And I think that's probably a red flag right there. If someone does not know how to comply with securities law in their coaching, social media advertising, that's a huge red flag.
Huge red flag. But I think like I was telling the story before we went on air, right? Like when in one of our projects, someone wanted to come in, they weren't accredited, no problem. Hey, the REIT's coming up. That you'll probably be okay with that. Talk to our EMD. If that makes sense, it makes sense. And then the response I got was, yeah, but why don't you just say that I'm a family and friend? Yeah. I've been in other investments like that. They just say that I'm a family and friend. But we're not, right? Like there's the OSC has a criteria of what a friend is, right? The one that gets described to us a lot by our lawyer and EMD. In fact, they use the exact same example, so I think they're probably right. Is like if we're friends, then I've probably been in your house. I probably know the color of your kitchen and your bathroom, and like we're friends. We're probably friends, right? So I think I think there's a lot of I don't know if it's hearsay, but that other people are doing it must be okay. I think that's where things start to really.
That's the ignorance.
It's the ignorance, right? Yeah.
Well, you guys have been around a long time. Lots of investors did non-conforming properties, like non-conforming multis.
Yeah.
And like Toronto, for example, doesn't seem to really care, but until they do.
Until they do. Yeah.
Hamilton forever did not care until they did.
Yeah.
Right.
And I guess that's okay as long as you know what the risk is. Like it's okay. One day down the road, if they decide they start to care, here's what's going to happen. And if you're okay with that,
budget for it.
Then go. No
budget
problem.
for those fire escapes and whatever you need to do whatever
Yeah.
else. But it's expensive.
Yeah.
You guys know. Fire escapes ain't cheap.
Fire shutters.
We had to do fire shutters recently.
Fire separation. And
fire separation,
like that.
And I think code even changed from like you could no longer do wood, you had to do steel, and then the cost went up even more.
Yeah. But that goes back to proper budgeting and knowing what your risks are, essentially, when you're underwriting deals, right? And it goes back to what you said, like as long as you know before, I mean, you're fine with it. You're either taking the risk or you're not. It's the investors that aren't aware and then say, holy shit, I got a $30,000 bill to do all this. Where am I getting the capital from?
So for the listeners' benefit, to explain where you guys are coming from before you start the REIT, like how do you describe your portfolio? How many doors, how many buildings, how many doors and buildings?
Okay, I'll start. I started way back with duplexes and triplexes, moved into apartment buildings in 2014. I think we're up to about 140 units that we manage. I also have another 100 and change where I've invested in projects as well. Say a couple of buildings, I think it's another 140 or so units, which I was the realtor on. so know the project well, decided to invest in these properties. So total 280, I would say 140 that we manage ourselves as asset managers, not property manage ourselves.
And whereabouts are they?
Mississauga, Hamilton, Barrie, Kitchener, and now Orangeville. We have one under contract in Orangeville.
What's in common for all these places that you chose to invest in them? Like I asked because you guys have been around. You've probably seen the same things. Like people are investing in towns you never. It always happens. Only when I got into real estate did I start learning about Ontario geography.
Yes.
In terms of all these small cities I'd never heard of before.
Yeah.
These ones I've heard of before. Yeah. And have friends that live in them.
Yeah.
I was just gonna say it goes back to the rain days. All good, economic fundamentals. Where's population going? What industries are there? As you mentioned, you see people investing in these small towns where they're like dependent on one industry. That industry goes under, slows down. What happens? Yeah. I'm not willing to take that risk. Well, at least not yet. Or if we're investing, other people's capital, friends, family, I was never willing to take that risk. So I just want a good solid market.
Right.
And that's pretty much where we decided. We also see, as you invest in Hamilton, St. Catharines, a very good increase in rents upon turnover. Right, so we're also looking for that lift because we are a value-add company. But yeah, the economic fundamentals of a city and population, GDP growth, all that stuff is primarily what we're looking at.
And I don't think it's. Yeah, I think it's. I like to think of like there's no bad strategy, right? There's no like going way northern Ontario or these smaller towns. It's not like it's a good or bad, right? It depends on what you need, right? So in those markets, the cap rate's going to be higher. Right, so you're probably going to cash flow out of the gate, but you also. So the other thing to think about, or people should know about cap rates, is the higher the cap rate, essentially it's a risk premium, right? So if you're getting a higher yield, the investment is riskier. That's why you're getting a higher yield. Lower cap markets, GTA, Hamilton, right? Lower cap, yes, you might not cash flow out of the gate, but it's also there's a lot of security around it, right? We're in there's investment, transit, and such, right? So especially now when the economy is doing what it's doing, the markets we're in aren't moving. Like they're doing better, right? Whereas the smaller markets, like Mike said, like if it's tied to one industry, two industries, there's going to be some issues there long term. But I think it's people just need to understand what their risk profile is and what real estate needs to do for them today, right? If it's cash flow out of the gate, yeah, then maybe a Northern Ontario market, as long as you know that there's some volatility there, or could be. But we've stayed away from those.
Because you're almost GTA with all these. GTA descriptions always changing.
GTHA maybe, plus.
Plus. Yeah, because I'm not sure Orangeville fits in, but besides the point, like
probably
it's
sizable.
It's still a sizable city.
You know what? I think one of the primary reasons we're there is I live 5 minutes away from there, from this particular building, and I really understand the area. There's also a couple of bigger players in that space that have just moved in over the last handful of years. But I really understand that market. I see where rents are going, and one of the guys I know that personally owns upwards of 1,000 units said to me a couple of years ago, he goes, "Oh, my building in Orangeville," he's like, that building's blown my expectations out of the water. I didn't know it was such a great city. Rents are through the roof, and now living there, I really start to see that zoned in. Something happened to come available, so we jumped on it.
So I want to ask you, but we were talking before we were recording about like how much effort is it to get here, get to where you are, because that's what I want. The show is called The Truth About Real Estate Investing. So I always ask people, like, what is it like to be an apartment building investor with 140, 200 units, whatever it is? Like, what is the amount of effort? Because again, I can't. I literally told someone just 2 weeks ago, a young guy, smart kid, has his MBA. He's like, he kept asking me all these opportunities from different influencers, right? And I said, stop watching social media.
Yeah.
Turn that off. You're already on the right track, right?
Yeah.
Don't be chasing these other shiny things, right? Yeah. So that's my point. So, anyways, what's your week look like in terms of workload, and then what fills it?
Yeah, I think so. Right now, with the launch of the fund and the REIT, a lot of it is. So I guess we're splitting up in two. So we split up our business in 3 buckets, essentially. Just kind of how we manage our time and our resources, and the way we kind of collaborate in status and such. So bucket 1, in no particular order, capital raising marketing. So what do we have to continue doing? Because we still have to put a lot of effort into capital raising. Yes, we have the help of an EMD now, but it's still in the capital raising conversation or decisions today versus 5 years ago are different. Like I don't know if it's more sophisticated, but it's just different, right? The capital markets are, we have to operate within capital markets. So there's capital markets. Then there's acquisitions, right? So, with Mike's background in acquisitions and his connections in the network, that's a continuous effort. And then operations. Operations is, property management. We have property management on the majority of our units, renovations and turnover and such. So our time is split amongst those things. Refinances, we're going through a bunch of refinances right now. So that's effort, a lot of effort right now. So it's not, we're not hands-free at all. Like, I don't know if
not 4-hour work week?
Yeah. No, not a 4-hour work week.
Not a 40-hour work week.
Not a 40-hour work week. So it's a full time, like we're not a startup because we've been doing it for a while.
Wait, but you guys aren't retired?
No, we're
startup. Not. That's the opposite of retired.
It's 100% the opposite. This is so I was in a startup before, and this is exactly the path, right? It's a shit ton of effort. I don't know if I can swear. It's a lot of effort, right? It's a lot of effort. Resourcefulness is a key component, meaning that not just your time, but can you leverage, your network and people around you. Now, I think we've decided to do that, though. Like, we've decided to continue to grow. If we decided to not continue to grow, yeah, maybe we have way less time to spend on this. I don't know. But we've decided to continue to push and grow and expand. Yeah, it's more than a 9 to 5 for sure. It's a 9 to 9, 9 to 12. I don't know. It's
doesn't sound retired.
The one thing I will say, it does allow a little bit of freedom of time in a sense where you can take the kids to school, you can pick them up, you can take them to hockey. You're just now working a little later or choosing to, right? How fast do you want to grow? What do you want to do? If you were to say you want to get to 100 units because at 100 units the cash flow will sustain your lifestyle, you could push to get to that 100 units and then probably work a 5-hour work week if you've implemented proper systems in place. You have your property management running them. I mean, you might have some months that are more intensive through refis. You may have a month or two where you don't need to do anything, essentially. Right? You can live on the beach with your cell phone, just maybe take a couple Zoom meetings here and there, and that's it. But if you're looking to get there 0 to 100, and you're looking to do it within a certain period of time, you're pushing, right? If it's not the acquisition you're looking for, it's capital. Where are you raising capital? How are you marketing for capital? Right? And things like that. So there's always something on the go, right? And when you get to that size, there's always tenant issues that you're dealing with, construction management, deficiencies in properties. Something is always coming up.
Even with systems in place, stuff comes up.
With systems in place. Although less though. Yeah, way less for sure. There's definitely more of a buffer now, which is nice.
One thing that always kept me away from raising capital was the investor relations is what I think the term is, the formal term. It's basically managing your capital partner. Where does that fit in with your 3 buckets?
Capital raising. Capital raising.
Oh, okay.
Yeah, it's kind of capital raising / investor relations. Like in that bucket, it's cap raising, but also communication back to investors. Reporting, tax slips, like all that stuff is kind of in that bucket. Anything to deal with investors, I guess. In there, you could probably put in, also lender relationships and financing. Like that in itself is. Yeah. It's capital. Capital is a big bucket, and there's a lot of spokes to capital, but it would be in there.
Yeah, I think that like the lending part would go there and under operations as well, because you're always dealing with new rent rules and stuff, and sending that to lenders, and let's increase. So it's kind of mixed between both buckets.
Doesn't sound like you guys are retired.
No,
not yet.
No.
What do you think the expectation should be then because we were talking about like people that take weekend courses. For someone who takes a weekend course, for example, to go to 0 to 100 units successfully, because I think we've all seen deals people shouldn't be doing.
Yeah.
So those will not bring people closer to their goals. But say they do actually find deals that they should be doing. How long do you think that should take? They're working 9 to 9.
Okay, so this comes back to capital raising, at least in my opinion, is, okay, you want 100 units, where do you want 100 units, right? And we teach a course, and the first thing is your why. What are you looking to do? Do you want to invest, close by? Do you want to invest, in another province? What do you need real estate to do for you? Once you figure that out, if you can get a value of those 100 units, say you're buying at $300,000 a unit and you want 100 units. Well, now how much money do you need to acquire that? Right? Regardless of acquisition. So some people have a good network. Some people been working, on Bay Street maybe, and been in the, financial industry for a long time, and they have family with money, a big network of accredited investors. Maybe they can raise that in 2 years. Who knows? Right? But someone just coming from a normal corporate job making 80 grand a year, I'm going to assume that they don't have a big network of investor capital, especially in the accredited investor space. So regardless of finding these properties, how are you purchasing them? With what? Right? And that's what it comes down to. I don't think there is a time limit. Mark may be able to do it in 3 years. It might take you 5, me 15. Who knows? Right? It's very difficult to say, because just because I'm working 9 to 9, it doesn't necessarily mean I'm attracting the right capital partner. Right? So it's kind of an open-ended question. And it's tough.
If you say yes, so let's say 100. Let's say you're doing even a building a year. A building a year is a lot, like for a person, or maybe it's a group of people. Like a building a year, like 20 units a year, maybe 2. You got to find the deal that makes sense. And now, like I think we're coming out of a period where, and I'm talking about 2020 and 2021, where you can buy a building, BRRRR it in 12 months, and you have all your money out and do it again. Like that's not happening anymore. Those times are gone. So, and if you're searching for those, I don't even know if you're buying a building a year, because those are hard to come by, right? Especially with tenant laws now tightening up. So if you think a building a year, 20 units a year, which I think is aggressive, if someone's starting on their own, that's 5 years to get to 100. I would say some people could do it faster. It might take longer for some people, but 5 buildings or 100 units in 5 years, I don't know. That's probably a target. I don't know if it's a fast target.
Okay, so we bought our first building together in 2018. We're probably together 18. At about 100 units or so, ish. Yeah. And that's 5 years of going. Yeah. Like going full time. But you had 2 partners. but 2 partners.
Right. We had an early start. Yeah.
Right.
Yeah, we're doing
2 partners with an early start, and we're there at the 5-year mark or so.
That's actually, I think that's really helpful to know. Like, you had a running start. It took you 5 years to get there in partnership.
Yeah. So technically it's 50 units, right? And it's not 50 units sold. We have partners on those as well, right?
So can you retire? Could you retire?
I think we sold everything.
So it's an equity thing.
Yeah, I think if we sold everything, for sure. Like if sold everything, and sometimes, it crosses the mind sometimes. If you sold everything, for sure. Yeah, like I think it would be good.
Oh yeah, that's crossed my mind.
Yeah.
Sell everything.
A couple times a year it crossed my mind. Yeah, it does. No, but sometimes obviously you go through, and I'm sure you hear this a lot, but people are like, "Oh, I'm done." You go through those stressful moments, and I think that gives me personally a peace of mind, knowing I could if I wanted to. I know I'm going to be working till I'm 90. I'm not going to stop. It's just something I enjoy doing. But I like knowing, hey, if I needed 2 months off, 3 months off, whatever, I could take that. As well as if I just had enough, went through a breakdown of some sort, I could retire.
So we were talking about this before we were recording. What you're saying is you can't live off the cash flow of 100 units, even though I'm going to guess you guys bought pretty well.
So right now, there are different stages. So some buildings are in CMHC, so at like 2%. So those are cash flowing. Some buildings we're in the process right now of refinancing three apartment buildings into CMHC. Those will cash flow. Combine the whole portfolio, off cash flow. We wouldn't be able to live off cash flow on all those buildings. We have investors on some of them. We wouldn't unless we sold a building or although refinances have helped. So refinances and equity takeout, that gives the most capital way more capital than a cash flow. So we've been able to refinance a few times over the last couple of years, and that's given significant amount of capital, way more than cash flow.
Do we want to go down the rabbit hole of buying a non-cash flowing property versus a cash flowing property?
Sure, because I'm sure you've bought projects. Like if you got like a nice tasty disaster project that's like 30% vacant, there's no way it's cash flowing.
Most of that's all we're buying, right? Is except for one we bought CMHC out of the gate. That cash flows 4 to 5%, on an annual basis.
Sorry, 4% of what? Is that
of equity,
cash on cash?
Of equity, cash on cash. Yeah.
Okay.
Yeah.
So for listeners' benefit, say you put in $100,000, you're cash flowing $4,000 a year. Yeah.
But our strategy is value add. So maybe that's the context. Our strategy is value add. So these things are by definition underperforming, right? They're not cash flowing. The debt coverage ratio at purchase is under 1. So that means that the income to support there's less income than the service of the debt at the outset of the project. And so our job is to turn that around and reverse it, right? So at the outset, all these do not cash flow. And that's where the value is for us, at least in our strategy.
Mm-hmm. And that's the thing I think all investors need to understand. Like investment is so diversified.
Yeah.
Like for example, the land investor does not cash flow.
Zero. Yeah.
Not saying it's a bad investment.
Yeah.
Because there's always I think we know plenty of rich builders.
Yeah.
Like I believe the person who owns the most expensive house in Ontario is the owner of Mattamy.
Right.
Apparently it worked out.
Yeah.
Not cash flowing on land for a while.
Yeah.
Right. But yeah, so you take those but you're playing for the longer game.
Well, this is the thing.
And you budget for it too.
Yeah,
right?
We don't need the cash flow today. So what we're doing is we're looking at cash flow in 5 years, 7 years, 10 years. What is it looking like then? So if I were to buy in a cash flowing market that doesn't appreciate, say somewhere up north, and it's providing me a 5% cash flow, if I'm not looking for cash flow for 5 years, I would prefer to buy the value add property in a more populated area that has the economic fundamentals, put it through the stabilization process, get the rents up, sit on it in cash flow, right? Because I'm going to get my value, I'm going to get my cash flow that's probably going to be more than a northern market in 5-7 years from now when I need it, right? So a lot of times I get newer investors ask me that question is, we were taught not to buy a negative cash flowing property, like we stay away from it. And it's like, yes, I understand.
If you can't afford it, yeah, absolutely.
But yeah, for sure. But what are your goals? Like that's the other thing too. If you can't afford it, definitely don't get into it.
Yeah, don't do that.
Right? You'll get buried very fast, right? Yeah. But I mean, if you can and you're looking at cash flow in 5 years or you plan to retire in 10 years, maybe a building today that doesn't cash flow and you're going to put it through that stabilization process is the better way to go.
Mm-hmm. Like your ROI will definitely be stronger. You just, again, it's risk reward, right? So your ROI is stronger, but you are going through a little bit more risk, right? Because you're buying something that's underperforming. You got to weather the storm for 12 to 18 or 24 months. So you have to budget for that. Whereas, if you're buying something that's cash flowing out of the gate, the benefit is you're cash flowing out of the gate, but long-term ROI is probably not going to be as strong. So it just depends on what the person needs and when.
So I imagine you guys understand the answer to this question is, again, one thing that's kept me out of multifamily is just how difficult it is to find a deal. So where do you find a property worth buying? MLS, right?
So I've spent
at the weekend
course.
We've actually bought the first building off MLS.
Yeah, at least two for sure, off MLS. Yeah.
I've spent probably the last 5 years or so really looking at who sells majority of multifamily buildings in the areas that I'm looking at, whether it's through RealTrack or not, and really building relationships with a lot of these brokers in the space. So I don't technically go out to building owners directly, which I have. St. Joe's project it was, but primarily is building relationships with these larger brokerages that sell majority of the buildings. So a lot of times I'll get a call to say, hey, we're working with a building owner. We haven't signed the listing yet. I think it's going to fit what you guys are looking for. When I get the numbers, I'm going to send it. Are you guys in a position to buy? And a lot of times it's like, yeah, when you get it, let me know. So I'm hearing about these things sometimes 3-4 months before these brokerages even sign the listing. Right? They're kind of prepping who's my, buyer database, what can we do, what do you think you would buy? Sometimes I'm getting prelim numbers from these guys, so they're probably going back. But you realize that a lot of, the acquisition side is very relationship based, right? And the main reason why I went the broker route and prefer to go the broker route is because a lot of the bigger buildings that I think we're going to get to in a short period of time, like right now we're buying, 15 to 25 unit buildings. But when you're looking at larger buildings, 40s, 50s, 80s, you really start to see the efficiencies, right? So that is another reason why we went, the fund and REIT route, is to raise enough capital to be buying these bigger projects. Well, these bigger projects, there's a handful of brokers that do $1 billion plus worth of sales. For me to come in and try and compete and get that listing or buy it directly is slim to none. They're going to go to the Colliers, they're going to go to the CBRE, right? So if I can just manage the relationship with some of these bigger brokers and have the inside deals, that's where I want to be. That's where I want to be positioned. And I was lucky enough to, work for another REIT in the acquisitions department, led the acquisitions department, and that's allowed me to build relationships with a lot of these brokers before we got to that space. Right? So that's where a lot of the deals are coming from. A lot of these, in-house brokers, sometimes they don't even sign a listing. They're like, just bring me an offer. The owner doesn't want to sign a listing, so we get a little bit of an in-house, and we got to pay the broker direct. Right? The Orangeville deal actually that we're purchasing never got listed. Just the broker ended up talking with the owner direct. The guy didn't want to list it. We ended up bringing an offer through. Ended up working through it and getting a deal across, or we're firm now, so hopefully across the finish line.
So sorry, I don't think I've covered that in the show for a while. You had to pay the broker directly.
A lot of times in multifamily, the purchasers are paying the broker.
So there has to be a good relationship there.
There does.
For them to tell you about a property they don't have under contract.
For sure.
Yeah,
100%.
Right.
But also, like,
you can't screw me because.
But we're not in that position, and I think I've done deals working for another mutual fund trust, so that relationship is there. But they also know that we're younger in the industry and we want to grow. So if we start screwing up relationships and I'm trying to save $100,000 on commission, I'm never getting any deals again. Right? So yeah, there is that trust factor there for sure.
That's awesome. So a couple things there. A lot of things. So I'm nosy. So how do the logistics work for you paying the broker for putting the deal together? You pay them on closing. You have it's in the agreement.
It's in the agreement. It's done through closing. We'll sign a co-op agreement, and it will just
even though there's no listing agreement.
Sometimes they'll have their own co-op agreement. I've done it too, where I'm brokering out, where it's like a separate contract. I guess it's a commission trust agreement,
right.
Essentially, which is just me and the broker saying, on this deal, they've referred me to this client, and us, the buyers, are willing to pay X amount.
Right. For the listener's benefit, why would an apartment building owner not sign a listing agreement?
For two reasons. One, they don't really care to sell, right? So I think when you see paper in front of you, and over the last couple of years, uncertainty in the market, they start saying, oh, maybe I should, maybe I shouldn't. But I think it plays a psychological part in the seller's head to say, oh shit, we have something here that's serious. Should we not? For example, just think of yourself. You're not selling. Someone brings you a good offer. Rates are going up. You may in 2 months call back, right? I've submitted massive offers on stuff, on portfolios, that me as the buyer for a client and the broker know that they're not selling for 2, 3, 4 years down the road, but he wants to put it in their head that when they do think about it, they're calling him first. Right? So I think that's one reason. And one, people don't want the exclusivity. So as a seller, I may come to you and say, hey, you have buyers, bring them forward. I may go to 3 other agents in my office. I may go out to a bunch of them and say, hey, bring me some offers. Right? And not really, and you can probably negotiate commission that way, because no real marketing's being put in place, but they know these bigger brokerages have big buyer pools. So whether there's full-fledged marketing in place or not, and I think they believe they can potentially save that way.
Right. So then how does a beginner break into this market? to get the same deal that you would get. To see the same deal you would get.
Very tough, very tough. And we've had some of the guys on our podcast as well, and they described it as like a old man's or an old boys club. Mm-hmm. Like just everyone wants to stick together, because if I know you're a buyer, he's a buyer, and I have a building come up, and
how many buyers do you need?
No, but I'm saying you have
many.
5 or 10, 20 on your list that are seriously looking.
Yeah.
Why would I even consider bringing someone new in there? I have a relationship with you, and we've been doing deals for 10 years. I don't care if someone new's coming in. I don't even care if the price is higher, because I want to know that, he can close, and I have 20 people with reputations of closing. Mm-hmm. My seller has an expectation, and if you guys are all meeting that expectation, I'm not going to bring him in. What for? Right? So it's very hard to crack in. I would say it took me 2 years before I really started building these relationships with people saying, hey, let's go for a beer. Hey, what are you doing? Let's go for lunch. I did it through, people laugh at me, but I enjoy FaceTime. Like if I can drive to Toronto because I know someone's going to be there for 5 minutes at a building, I'll go down there. I'll go down there and say, hey, what's going on? Just to build that bit of relationship. Right? I couldn't crack through it online, an email, a phone call. People don't know who you are. They don't see your demeanor.
They don't see your Instagram stories?
Whether they do moves. But you know what? On top of all that, I do think that plays a part while you're building a relationship, right? Like we've started running and things like that, and I'll get calls. Oh, that was a good run, because I have the relationship now. They're also seeing the social media, right? Or it becomes an easy conversation. Like one of the brokers I know is into sports. Caught a wind early on that he's into sports. Big Blue Jay fan, right? So when I would see him, I'd say, "You see the Jays game last night?" Right, like small things like that to build a connection outside of real estate. Mm-hmm. So like, this guy's a good guy. I want to pass him the next deal. Mm-hmm. Right,
staying in front of people.
Of course,
maintaining. Yeah.
And that's how I've done it. I'm sure there's multiple ways, but yeah, it was tough. The first couple of years, no deals, nothing. I'm like, this is tough, and that's where the consistency comes in.
Right, that's
when you stop,
So like no returns or like poor returns for a while.
Nothing.
So when you mentioned you did buy 2 properties off realtor.ca or something like that. Was that early days? And then what was it about? How did you make it work? Because again, those properties likely went through many people before you ever saw them.
So I think probably the profile of the seller, or at least the Mike can speak to this better than I can, but the 2 in particular, they were not commercial brokers or commercial realtors, right? So that's an advantage to guys like us buying. They might not be able to value it properly, or the negotiation strategy. They might not have a buyer's list. So that's it. So the first one was on for a long time. Like these buildings were on for 400 days, I think it was, right?
Holy cow! What was wrong with it?
So the pricing was not right. So pricing was an issue. The buildings were fine. We've had in the portfolio now for 5 years or so. It fell through twice. And so I think the advantage of going after realtor.ca or MLS deals, let's call it, if you're a serious buyer, is MLS deals may not attract serious buyers. They may attract people that are kind of thinking or first-time buyers, for example, first-time building buyers. And first-time building buyers might not know how to finance it properly or not be able to close. And so in both situations, actually, we were not the first to the table. The deal had fallen through. The first one, the deal had fallen through like twice, maybe 3 times, and then finally, we were able to close on it. The second one, this was a Kitchener, same thing, fell through once, maybe twice. And so once it this, like once a deal falls through, the seller is like really skeptical now and like really kind of worried, is this going to happen? And so
because they're getting grief from their tenants, they're getting grief from their apartment manager.
Right? So.
Especially if they didn't want to sell in the first place.
So I see it as a benefit actually going after MLS deals, because usually the realtor are not commercial, because if they were, then they wouldn't be on MLS, right?
It would be sold.
It would be sold already. And it's attracting, a wide array of buyers. Some serious, maybe some first time. And so at some point the seller or the agent is going to get fed up, right? And so I think with a track record like ours, or, brand and, the ability to close, puts us in a better position.
I would say at max that's to 15 units. So 15 and under is where you see a lot of that happening, because people aren't familiar in that multifamily space. Anything bigger, you're getting more educated buyer, usually across the line, or How often do you see like a 40 unit building on MLS anyways? Doesn't usually happen, but the smaller ones is they're interesting.
I remember like 10 years ago, like one of the really dominant realtors in Hamilton had like a pretty sizable building on the market, and this was on the when the market was getting on the way up, so it was really early on the way up. And so like you guys were probably there, I was there, all of our mutual friends were there, going through the property. It was hilarious. The lineup was like, it was you know, like those you see it on. I never do these things like those lineups of realtors for condos.
Oh
it was like that. It was all investors. So like we saw all of our friends.
Yeah.
We were all going through the property. We saw like we all went through. Everybody went through like 3 suites or something like that.
Yeah.
It was that much of a production.
Mm-hmm.
But I think that was the last one because it was like there's way too much demand. We don't need to do these things. Everyone was pissed. Tenants were pissed. Property manager was probably pissed for how many people went through and had to deal with all this crap, right?
And also like from the seller's point of view, not all sellers, and I would say probably more so than not, don't want their tenants to know that they're selling, right? Because what if it doesn't sell, right? Or like it just causes, creates questions. And so kind of, the idea of being off MLS and going with these brokers is kind of a little bit of secrecy too, right? Like, so there's no sign in the front, right? It's not posted everywhere.
Lots of serious buyers.
Serious buyers only, right?
Serious buyers out there. Like, this is pretty competitive, is it not? To get a good building?
Yeah.
And
the
you
good
want
build
that
for
negative
sure.
cash flow and you have to stabilize.
Well, there's more demand for those, right? There's more demand for the value adds because there's value, you can add value, right? So.
And the yields have come down, have they not? Like, actually, what is your... Once you're stabilized, what is your yield? What is your cap rate, roughly?
It depends where.
I understand. Like,
I would say
you're different than Orangeville.
Yeah, you're probably stabilized now in and around 5 cap.
Wow.
Yeah. For fully stabilized.
Remember
but what's considered stabilized now? That's the thing. Like, people look at it, there's a $200 lift. Yeah. Well, that's now a slightly lower cap rate, or there's no lift on it. It's fully stabilized, right? So the cap rates are going to adjust slightly from that, but I would say somewhere at 4.5 to 5.
Right. So the reality is, people really cannot live off the cash flow of these things easily.
No.
Nope. You have to have a fairly big portfolio.
Yeah. Right. How big?
Well, it depends. Here's
the goal for people.
If we're buying something stabilized, unstabilized, and we're going through the stabilization process, and then just refining out the current debt we have on it, then your cash flow is going to be significant.
Yes.
Because if you're buying at $3 million, for example, you put $1 million in, so you're $4 million in, but now your value is 7.5, and you only have $4.5 million of debt. Your cash flow will be probably upwards of 5% cash on cash.
Yeah. Right. Yeah, it's true. So I think. A lot of the conversation around kind of borrowing and taking all your money out, well, you're taking all your money out at the trade-off of having lower cash flow in the end. Like, you can cash flow significantly if you don't take all your money out. So it depends on what the equity takeout is, right? So I think but it goes back to what do these stack of bricks need to do for you? Like, if you're going to take out that money and that's how you're living, or you're going to take that and reinvest, or you just leave your equity in there and now you can live off, who knows, I don't know, 20 units, 40 units, and you don't need a ton.
Well, look at the new MLI CMHC. It's a 1.1 debt service. So as long as your expenses, which I would say in a lot of cases they're probably slightly more, you're probably just over 1 in a debt service, so you're not really cash flowing. Right?
You're taking out a lot more, but you're not cash flowing. Yeah.
And you guys have to work pretty hard. Like, for example, like you mentioned, like in your course you say, like, what are your goals? My goal is I like being a side hustle investor, so I'll stick with my duplex, triplex, student rentals, right? Because I don't want to be 9 to 9 like you guys, you young guys.
He's young. Yeah.
All right, we're running out of time. So you have the Canadian Real Estate Multifamily. What's the name of your podcast?
The Canadian Multifamily Investing Podcast.
Yeah, that's a mouthful.
I know.
Why couldn't you just call it M&M?
M&M, yeah, that's right.
The M&M REIT. Like, literally, there probably be some issues. Talk to your lawyer.
Yeah, that's right. That's a different lawyer, trademark lawyer. That's like a whole separate, like, as a new engagement. Yeah.
You can get in rap battles.
Yeah.
Promote your REIT. It'd be awesome. What else? I've hogged a lot of the questioning. What is it ultimately that you guys like about what you do, and about what drove you to do the REIT, and where's that going to take you?
I think so. I think Mike mentioned it, like the scaling aspect, right? Like the ability to scale. I think it's two components. One, the scaling, but also just to be louder in our marketing while remaining compliant. Scaling capital so that we can scale the portfolio, because there's definitely benefits in number of units from an efficiency standpoint. A 50-unit building operates more efficiently than a 20-unit building. Mm-hmm. And to build, to continue building. I mean, I personally like business building. Like, just this is, it's and it's not always 9 to 9, right? But just this idea of, or this process of creating something, from scratch, growing it. That in itself has intrinsic value. Mm-hmm. Like, I enjoy that, and the financial benefits kind of are there. But yeah, I mean, I think our goal is to really just kind of scale this. How large it's going to be, I don't know. It's a $50 million fund right now, meaning $50 million in capital, which will buy us probably $130 million of buildings, 130, 150 or so, give or take, depending on what the values are. And so that's step one, is let's get to $130 million portfolio and go from there. Yeah.
If we have some time here, you asked a question off camera that I think would benefit the listeners about partnering. Why it makes sense to partner. And you see a lot of partnerships happening where there's just a synergy, but you look at them and say, you guys have the same skill set. Like, why would you guys partner together? Yeah. Right? So that's always been a topic.
They partner with someone just like them.
Yeah.
Which is not what you're supposed to do.
Mm-hmm. Yeah, and I mean, at the beginning, there's obviously synergies. Everyone's excited. Yeah, let's partner. Let's buy a building. But I think for me and Mark, it works well because I have that acquisitions background and he's got that marketing and sales background, where I've never really been interested in raising capital. I'm not good at it. It is not my thing. Where Mark enjoys that marketing, building funnels and things like that, bringing people in. So it works well in that aspect. And if you go back to the three buckets, I mean, he's capital raising, I'm acquisitions, and operations kind of works together. Like, we're both in it. And I think operations at some point in the near future, when we're large enough, will probably be held by in-house property management, maybe a manager of property management, something like that, where we won't be putting much effort. But I mean, just having two totally different skill sets really, really complements the business. Where, as mentioned, you see, like, I have friends, they're partnering together. I'm like, why don't you just pay them like a consulting fee or something? Like, there's no need to have.
You don't give them equity.
50%.
You don't need to give them equity.
50% of the business.
Just pay them for the job.
The other thing I think about
like, you pay your contractor, you don't give them equity, right?
Yeah. The other thing I think about partnerships too is like, what's the role of a partnership, right? I think, with Mike and I think this is important too, is that we debate a lot, right? We don't see eye to eye on everything. And I think that's super important. I think that's, I think if you agree on everything, I think that's probably a red flag at some point, right? I think the fact that you can have a debate, challenge what needs to be challenged, that's super important, not just for partnership, but just for business growth, right? Like, I think we're challenging each other all the time. And we have different perspectives on things, right? Mm-hmm. And I think that, if you didn't, then one person's enough to grow something. But, if you have two different angles at it, then that's super, especially now, right? Where options, the number of options matter, right? Like, in terms of, where are we growing next? How are we refinancing? There's so many ways to slice and dice all decisions, right? And so having multiple brains on it is super critical. We also have a board advisor as well that provides another perspective too, beyond just kind of ours, which is helpful.
It's actually interesting you brought up the board of advisors, because I wanted to ask a question around competition, and because I find a lot of people out there do this wrong. I'm gonna guess you guys do it right, because I'm gonna guess on your board of advisors is probably your previous employer.
No, it's not.
Oh, it's not, eh? How do you get along then with your previous employer?
Mine, or
I'm more looking at Mike's.
Yeah.
Previous employer in what sense?
Who you were doing acquisitions for? Like, you were doing acquisitions for another REIT.
Yeah, well, that was kind of like a subcontracted job. Very well. I'm still there working. We understand all the conflict. I'm on my way out in a sense. They want someone full-time in-house where I couldn't commit. Yeah. But the relationship's still there. If I get stuff that doesn't work for us or too large for us, I'll gladly pass it along.
Right. So that's actually, I think that's really important to note, is that that relationships can be maintained. Yeah. Because what I find is like Like
Yeah.
I've seen out there in the market, literally people steal from other people.
Yeah.
Right? Like they'll take their course or they'll take their book and they'll just rip it off. Like you learned a lot. You have like long time relationships with where you used to work.
Yeah.
Right? And you're able to keep it. You're able to maintain that healthy relationship.
Yeah. It goes back to like childhood days.
Yeah.
It's just, I think the understanding right from the beginning, the expectations were set out very loud and clear. So it's been great, and will continue to be great.
Right. I think also because you both had that abundance mindset going in.
Yeah. And
you knew that about each other, versus some people are just all about themselves.
Mm-hmm.
Yeah.
Mm-hmm.
Versus like they were. I'm gonna guess that they knew that they're happy to help groom you to be on your own.
Yeah, that relationship's different. But yeah, I just came from a very, very young age, so it's different than most.
Yeah,
to say the least.
I'd say you're lucky. Any final words? Where can people find the podcast? Where can people learn about the fund? Because did they go to the EMD to learn about the fund, or what is it?
No, they can go to our website, peakmultifamily.ca. There's info there. Fill out one of the forms, and there's a lot more info that they can have, like frequently asked questions, the overview of the fund, like the facts of the fund, and and if anyone's interested in learning more, even determining if it's right for them, then we'll put them in touch with our EMD or dealing representative, and then they can have that kind of financial conversation with them.
Fantastic. And then selfishly, again, someone who's cheap, I'm gonna watch your social media to see how I can stay on the right side of the Securities Commission. Okay, so that's how they set it.
That's how they do it. Yeah. It's actually, what's interesting is you can actually do a lot. You can actually do and say a lot, right? There's a couple rules of thumb, right? Again, not a lawyer, but here's what we've been told, right? You can talk about returns, right? But they're not guaranteed, right? You should have a disclaimer. Right. So there's a bunch of things that. So it's actually, I don't know, it's been a little bit more liberating. In fact, through the process, we're realizing that we can say a lot more than we thought we could. I think we were probably just conservative in general before and just worried that we were going to get in trouble. But we can do a lot more than we originally thought. I think we're a little more confident because we have a chief compliance officer that reviews it. And so it gives us, I think, a little bit more confidence to say what we're doing. But you can say a lot as long as your back end process is set up properly, and your how you're vetting investors and determining suitability. And you don't need an EMD to raise capital, right? Like that, you don't need that either. But there's certain rules that people do have to follow, which seems like a lot are not following. So.
Right, but to scale up, it's necessary.
Yeah.
Fantastic. All right. And where can people find the podcast?
It is the Canadian Multifamily Investing Podcast.
They can find it anywhere?
Yep, and all the platforms. Typically, if you search Canadian Multifamily.
Google Podcasts, Apple Podcasts, Spotify. Okay. Should be on all of them.
Amazon, I think Amazon.
I was listening to see if there are any new ones that I'm not on yet.
Yeah, I know. Amazon. Actually, we weren't on Amazon or Audible, but now we are. I think as of this, we just released an episode yesterday, and to our editor, like, hey, are we on Amazon? How come we're not on Amazon? Oh, okay, I'll get you on Amazon.
Right.
Yeah.
Yeah, but if you only just recently found out about Audible, how many people know Audible does podcasts?
Yeah, I don't even listen to podcasts on Audible.
Yeah. I'm just on Apple Podcasts and Spotify.
Yeah.
Those are my two.
Yeah.
Cool. All right, thanks so much for coming in.
Appreciate it.
Thanks
nice.
for having us.
Good chat.
Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link's also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.